he's on a call, and so it's great, yeah, to have
Yeah.
everyone. I mean, it's growing. I imagine it's going to grow a bit more, which is quite nice.
All right. Well, we're doing the run in, so we'll just. Good evening, everyone. Welcome to the September 2024 Financial Fitness Worldwide webinar. We can use the term worldwide very freely these days because many of our clients are living in other countries now, whether it's to the east, to the north, to the west, UK, the United States, Canada, Australia, and so on. So we've got clients all over the world, and we've got people to speak to us from all over the world. So it's going to be a really great webinar for you, lots of information. There hasn't been that much happening this year. So, there's only been ultimate election year, which is about 64 countries are actually having elections during 2024, affecting more than 1 billion people. And so obviously you've heard about the South African election, and you will be hearing a lot about the USA election in the next few months. So many things have been happening, and some of the things that are happening seem to be benefiting us here in South Africa. So that's why we're starting off this evening with Liam Hector, who has been with Anchor since 2014. And he's a very qualified young man. Most importantly, that he's been running funds for Anchor since 2014. And one of the funds that he is running is the SA Equity Fund, the Anchor SA Equity Fund, co-managing that with Mike Cresty. So Liam has long perspective and a very wide view sitting there in London, so he can inform us as to exactly what he sees happening with the JSE, what the effects of the GNU have been, what might be coming in the near term, and if we can get it right, just exactly where the JSE might be by the end of the year. But as Liam has informed me, we don't make those kind of predictions. So to get the ball rolling to this very action-packed webinar, I would like to hand the microphone over to Mr. Liam Hector. Welcome, Liam.
Thanks, Jim. Let me just get the screen sharing right. Yeah. Okay. Yeah. So thanks. As Jim mentioned, I sit in the UK. I think I have fairly unique perspective on South Africa, coming from the context of a much broader emerging markets view. So I've been in the UK for over 6 years now, predominantly focused on emerging markets, and still pretty active and follow South Africa very closely. As Jim mentioned, I sit as a fund manager on some dedicated South African equity mandates, as well as general emerging market mandates, both in long only and in hedge funds. So I'm deeply invested and very much involved still in South Africa, and it certainly, I believe, has given me some kind of unique perspective on South Africa. I'm assuming some of the things I'm going to talk about in the next couple of minutes or 20 minutes might be a bit repetitive to you, but I think as either somebody who's living in South Africa or somebody who's not living in South Africa that's just generally interested in what's going on back there, and for those of you who for whatever reason, whether it's regulatory or by choice, still have quite a lot of assets invested in South Africa, and I think that there is a lot of those people out there. I would imagine a lot of people have spent the best part of the last 10 years taking what they can out the country, but there's still a lot of money that we run for people in South Africa, and the good news is, for the first time in a very long time, I've got a pretty positive story to tell on South Africa. So I do these updates every 3 months for our audiences at Anchor Capital, and I know Financial Fitness is and their clients are probably invited to that and a part of that audience. But it's been a very tough couple of years, and I would say really going back to the end of 2015, so probably about 2 years into my career in financial markets, where it became increasingly clear that the structural challenges in the economy was going to result in a bit of a suffocation that was happening on the local market, domestic market. Most acutely felt probably in our cost of capital and the fact that growth just disappeared. So interest rates, as you know, are very, very high. Our bond yields are globally amongst the highest in real terms. And I think that's largely a function of a slow erosion that's really taken place in South Africa over that time. There was certainly some optimism back in 2017 and late 2016, or sorry, late 2017 and early 2018 when Cyril Ramaphosa took over as the head of the ANC, but that quickly cold air was quickly blown over that one, as it became increasingly clear that there was going to be very little that really changed structurally in the country over that time. So why do we feel the need to be a little bit more optimistic this time around? Certainly approaching it, the changes that are happening in the country from an investment perspective, we're certainly approaching it with a lot more skepticism and caution. But we actually think the setup for South Africa now, looking through a global lens, is very, very interesting. And I'm gonna highlight a bit of a journey, and I would say the journey, call it from the beginning of this year to where we find ourselves now. Our view, coming in was probably that South African assets just looked too cheap, but they had been cheap for a very long time. And we were looking for a bit of a catalyst at the end of the first quarter. It was our expectation that we were going to get through the elections and there was going to be some form of relief rally on the other side, but ultimately more of the same. And when we got closer to, or certainly post the election, there was a lot more anxiety because all of a sudden our prediction of the ANC at sort of 45%, partnering up with some smaller parties, and us as investors almost breathing a sigh of relief that there isn't some kind of change and radical shift to the left. You know, there was some nervy days early on there, and this really coincided with a couple of other emerging markets going through what you would probably consider the nuclear option, in the form of Mexico, where the left won an overwhelming majority, and immediately there was anxiety around central bank policy changes and the like, which really scares investors. So this was kind of happening at the same time that South Africa was in this purgatory where it didn't really know what the leadership outcome was going to be. And we have to admit, the outcome that we ended up with, even though it took us a couple of weeks, which by all accounts is almost record time, is far better than we could have imagined coming out of the first quarter of this year. So we kind of started getting constructive on South African assets, just saying that they were just completely bottomed out and too cheap, with a couple of shorter cyclical tailwinds on the horizon. So, you know, regardless of the outcome in the election, you were probably going to get interest rate cuts towards the back end of this year. The two-pot system, which I think is getting discussed later in this webinar, was going to come into play, which would be further consumer relief, and the inflation certainly moderating in South Africa, and really load shedding, lifting consumer sentiment. So the fact that there hasn't been load shedding for a very long time, and it continued to be low load shedding post-elections, where everyone just assumed that it was dressing up pre-elections. You know, these are pretty bullish factors, regardless of the outcome of the election. But then all of a sudden you throw on top some potential structural changes in the South African economy, and the cocktail together seems to be throwing up one that, you know, for the first time in I don't know how many years, certainly possibly the last decade, you know, South Africa could trend towards a 2.5% GDP growth. And we have not had these conversations for a very long time. And I can tell you, the companies that we've analyzed in South Africa over the last 10 years have had to adapt and survive and try and grow, albeit very slowly, you know, in a very constrained growth environment. And they've been incredibly good on cost discipline, and really having, it's almost like a bit of a street fight out there to try and eke out earnings growth. And with a 2.5% GDP growth scenario out there, we think that there's certainly a cohort of companies on our local exchange that are going to give you potentially a really strong earnings cycle over the next 2 to 3 years. So I'm going to move into the next slide, and I'm going to really highlight how we look at it. So this is deconstructing what we look at in South Africa, which is the MSCI South Africa index. I mean, it's quite a similar mix in the CAP-SWIX index, which is a lot of our local benchmarks that we use. It's a similar type of mix between commodities, rand hedge shares, and those companies focused on the real domestic economy in South Africa. And I can tell you our positioning for the last many years has been very much gravitated towards being overweight quality rand hedge shares, and being underweight domestics in South Africa, with a very strong quality bias and wanting nothing to do with smaller industrial companies on the JSE, which we believe were just not, we believe that the conditions were just not right for an earnings cycle there and any kind of re-rating. And you saw with things like capital flight in South Africa, the cost of capital really increased for those companies, and PE multiples came down dramatically over the last 10 years as growth evaporated. On the commodity side, you know, they're very cyclical. We've tended to be invested there over time at higher levels than where we are now. But for now, we think that there's enough to keep us interested in a potential complete structural shift over the next 2 to 3, maybe even longer years on the JSE, in terms of what we are observing on the ground, that play into the hands of a portfolio dominated by domestic shares in South Africa. Now, we are going to be quite critical and circumspect, and in a lot of the cases, we've probably since the election had about 45 different meetings with management teams in South Africa. We are going to follow an approach of really wanting to cherry pick our exposure. We at Anchor, we've got quite a strong bias towards quality as an underpin in portfolios. It certainly, when I started, was a quality and growth underpin. But as growth really became quite scarce, it was very difficult to build a portfolio around that. And so we gravitated towards quality. And what we think we're able to achieve on the JSE is a pretty hopefully predictable revenue and earnings stream over the next 2 to 3 years in a lot of these companies. Now, if you look at the performance of the JSE, and it really has performed well since the election, and just for context, the JSE has probably outperformed in dollar terms global markets by about 13 or 14% since the end of the first quarter, which almost makes some investors a little bit more nervous about getting in, worrying that they're getting in at the top. You know, what we've observed on the market is that actually not much of an earnings cycle has actually started being priced in. We believe that the initial reaction that you've seen in the market has largely been a reaction to the fact that our bonds and our cost of capital have moved from 12.5%, our risk-free rate in South Africa, down to 10.5%. And the moves that you've seen in our banking index, which is well in excess of 30% since the election, is largely a function of multiple expansion or rate valuation being increased as a result of cost of capital being decreased. And to be frank, the cost of capital discussion is two-pronged. It's a function of global interest rates expectations having been lowered, but also the political risk premium reducing in South Africa. So you've had quite a nice mix that's lifted our local market. Certainly increased interest in the retail and consumer stocks in South Africa. Once again, reacting to the fact that the consumer has been under so much pressure. These companies have been under so much pressure for the last 2 to 3 years, and all of a sudden you do have some consumer relief coming on the horizon in the next 6 to 12 months. So you've seen a reaction. We don't believe that the reaction that you've seen is really front loading a big earnings recovery just yet. We believe that investors are still largely on the sideline in South Africa. We believe that from all the foreign investors we interact with and have spoken to since the election, there's been very little foreign interest in South Africa, even though it's coming at a time where globally there's probably a little bit more edginess around where valuations are, about the rally that you've seen over the last decade or so in global equities. All of a sudden, the attributes that the JSE have got can make it quite attractive on a relative basis, and that's really the stance we've taken at Anchor, is that we believe, certainly have been for the last 6 months, that South Africa on a relative basis should actually continue to outperform global equities. Now, it's a very uncomfortable statement to make, considering the underperformance over the last 10 years, but not completely unrealistic. So I would say cautiously optimistic. We are certainly not all in on this, but we believe that there's certainly enough out there to keep us interested in South African equities. And for those of you who are invested and have liabilities in South Africa, have expenses in South Africa, we believe that for now this index is not a bad place to be invested. So and I can tell you that that's a welcome change in view that's taken place relative to the conversations we've had for the last 5 years. Just ending off, obviously we've seen a big move in the index so far. There needs to be additional fuel to sustain the momentum in equities. And what is that fuel going to be? It's going to be hard delivery. It's going to be data points that are going to come out. It's going to be people's expectations being raised after data points come out. It's going to be GDP expectations, consumption, credit extension in the country, appetite, and certainly some positive headlines from a structural reform perspective. And on that, and I know my time is running out now, I have not seen invites to investor meetings from South African delegations like I'm seeing now, at least for the past 5 years. So we are getting invited to. There's a complete charm offensive that is going on. I'm only seeing it on the London side, but I'm sure they're going to the US as well. They've got a good story to tell. There seems to be a lot of cohesion and willingness from both sides of the ANC and the DA. They're sending delegations that include Paul Mashatile, that include John Steenhuisen, and certainly some of the large business leaders in South Africa. And I believe that they're coming over here this month to tell a pretty positive story about the changes that are taking place in South Africa. So, I encourage you to follow guys like Frans Cronje. He gives quite a sobering perspective. And I can tell you that there is still a lot of skepticism, rightfully so, from foreign investors and I suspect from people on the ground in South Africa around the longevity of the government of national unity, but also the performance of the JSE. So I think that it's fine, it's rational to have that skepticism, but for now, we're placing our chips on the fact that this is going to be a good outcome for South African equities. We, on our models, still have about 15% upside over the next 12 months. So with that, I'm going to hand back to Jim. I think that's my time's up.
Liam, thank you very much. Very well timed and very welcome message. I'm sure that South Africans all agree with you that they've been waiting for this kind of news for a long time. And we do think it does seem as though we've turned a corner. And thank you very much, Liam and Mike, for the approximate 12% growth return you've given us so far this year. I think that's about right, isn't it?
Yeah, it sounds about right. Yeah,
by 12%. Yeah, and so there's more to come, because as Liam has said, the market, there's still a lot of people sitting on the sidelines waiting to see a bit more out of this GNU. So anyway, Liam, thank you very much. Love to everyone in London, and we will chat again soon.
Thanks. Thanks, Jim.
All the best. Ciao. Bye. All right, guys, now we're going to switch over to our next guest, who is Jaco van Tonder. Jaco is the head of advisor services. He's the director of advisor services at 91, and he's been there when it was Investec. And it became 91. He's been there since 2009, which is a fair old time to be trying to explain to advisors, the intricacies of what the 91 is offering. Some of you will recognize Jaco because he spoke at one of our workshops, webinars or workshops that we had at Greyston a while back, when everyone used to go out and go and meet each other in venues. But we're now in the modern age of webinars, and Jaco's loving it because he can be in Cape Town and still talk to all you guys all over the world, mostly in Joburg, but many in other parts of the world. So, Jaco, you've been following the retirement fund reform story, and you've been looking at retirement in general for 91 clients for many years. So you are definitely the man that we want to hear from on this topic of the two-pot retirement fund. So over to you, Jaco.
Thanks, Jim. Thanks for those kind words of introduction. Hoping everybody can see the first slide deck. It's good to be with you tonight. Not so great always to be in Cape Town, especially not this winter. We've had terrible weather, so I think the Joburgers have shown us one up on what the weather can do if you live in a city with decent weather. So us Cape Townians, for the first time this year, I think, had been a bit jealous of you Joburgers. So if we can zoom in on the discussion for today, maybe start the discussion off by telling people that I'm sure everybody has heard about the two-pot retirement fund changes that came into being on the 1st of September. There's been an enormous amount of media attention, and there continues to be an enormous amount of media attention. And that media attention is rightfully deserved, because this change represents the largest change to the South African pension fund system since the late 90s, when we moved from the old defined benefit to the defined contribution pension fund systems. So I would say easily, for the last 30 years, the two-pot system represents the most significant change to our system. And it's a series of changes that will affect everybody who is in any type of retirement fund, and will continue to affect you for the remainder of your working career until you decide to retire one day. So I think it's important that people get to grips with the basics and how those have changed. And so the agenda for today, we're going to focus really on three key areas. We're going to focus on just highlighting to people the principles of the system. Why are we doing this? What are we trying to get right? What are the basic rules about how it's going to work? Then we'll apply some case studies. So I'm going to look at some live examples of people at various points in their lives, resigning from jobs or retiring, and then try and explain in simple terms how the two-pot system changes those big life events, and why it's probably now going to be more important than ever to obtain financial advice well in advance of the date that you wish to retire, to make sure that your glide path is set up appropriately. And then we're going to talk about a couple of practical tips and some longer term comments if we've got time at the end. So let's get into the basics of the two-pot system. And let me start this with a question, which is the question of, why are we even bothering doing this? And when I ask audiences this question, and this would be audiences ranging from top financial advisors all the way through to normal investors, I often get the reply that people say it's something to do with COVID. You know, something happened in COVID, and maybe it's the same thing that happened with the DTI, where we all were told which Woolies underwear we were allowed to purchase and which hot or frozen chicken we weren't allowed to purchase as part of the lockdown regulations. But quite frankly, I'm happy to report that the two-pot regulations, whilst they got momentum during COVID, definitely do not have their origins in COVID. And that the problems that we're trying to solve with two-pot have been with our system for as long as I've been in the industry, which is well over 20 years. And those two key challenges that we're trying to solve with two-pot are really two sides of the same coin. And let me try and explain to you, the best way I can explain this to people is to say that our retirement fund system, when it comes to access for people before they retire, our system has been somewhat schizophrenic. And it's been a little schizophrenic because on the one side, when you are working, but you have some financial emergency, you are in the old system, you were unable to make use of your retirement fund to help you with that financial need. So if you, and COVID was a great example of this, people lost their jobs. People did not lose their jobs, but they lost their salaries and their income because the companies they worked for were unable to trade. And so people went from, whatever salary they were used to half of that salary, or sometimes only 30% of the salary, and they weren't able to feed their families. Yet they had 2 and 3 million rands in their pension funds, but they were unable to use any of that money to sustain them during the lockdown. So that's problem number one. Our current system does not offer emergency access to your pension benefits if you have an unexpected financial emergency. And if we look at other first world countries like Australia, as well as the US, their pension fund systems include some allowance for limited access if you have a financial emergency during your working lifetime. So that was problem number one. Problem number two was the exact opposite. Problem number two, which is outlined on the right, was that whilst we give people no access when they need it, when they have a job, when people decide to resign because they're moving to another company or they're taking up another position, we, for some strange reason, offer them the ability to cash in 100% of their pension fund. So when they need the money, we give them no access. But when they're changing jobs and they probably don't need the money, we give them all of the pension fund with available for withdrawal. And neither of those two make any sense. So the one on the right destroys people's long-term retirement savings because the stats are really worrying. In the old pension fund system, people who were aged younger than 30 years and who were working, the proportion of them who preserved their pension fund assets when they changed jobs was something like 10%. So over 90% of young working people professionally qualified people with high quality salaries, good education. In spite of all of those qualifications, when they in their mid-20s or late 20s or early 30s change jobs in South Africa, they take their entire retirement fund in cash. And so I'm hoping that Jim and his team have been resolute in explaining to you in the past why that is such a dangerous strategy. And so the two-pot system aims to solve that problem as well. So there are two problems: solve the emergency access problem, and then solve the too much access problem when you don't need the money. And so two-pot effectively does both of those. And so if we look at how it does that practically, well, let's look at the basic components that are going to be appearing on your pension fund statement. If any of you have been able to get a pension fund statement, I can say a little tongue in cheek, because it seems that the pension fund administrators are somewhat overwhelmed with the volumes of queries that they've received in the last week and a half since the system has launched on the 1st of September. But if you've been able to get a copy of your new pension fund statement, you will see that there are now different components that are included in your pension fund valuation. And you will see now that there's a box that's called a vested component. There's a box that's called a retirement component, and there's a box that is called a savings component. And every single retirement fund account now has these three boxes, and they all do very different things. So the best way to try and think about these three boxes is to try and think about what they want to achieve. And I'm going to start on the right with a vested component. The job of the vested component is to make sure that all your pension fund savings that you have collected prior to 1 September, which was last week Sunday, I think. So all of your old pension fund money that you had accumulated prior to 1 September, that the rights to those monies are forever preserved, and that you do not lose anything on those assets due to the implementation of two-pot. So the job of the vested component was to stop people from unnecessarily resigning so that they can cash in their pension fund, because they are worried that two-pot is going to damage their old pension fund assets. It will not. It's the job of the vested component to make sure that your old pension assets are preserved and locked down and safeguarded, with all the old tax and liquidity and cash flow and lump sum rights. Everything remains in place. So that's the job of the vested component. The job of the retirement component is to make sure that you don't cash your entire retirement fund in before you reach retirement. So the job of the retirement component is to stop the young 25 and 30-year-old professional person from cashing in their 1 million rand pension fund when they're changing jobs from one auditing firm to another. And it forces them in future to preserve 2/3 of their pension fund. And then the savings component on the left is the job of the savings component is to supply you with that emergency access that you unexpectedly require because of an expense that was unforeseen, whether it's a car's turbo that's blown, or you've driven through a pothole and you've damaged your car wheels and rims and you need to replace them, and all of a sudden there's a 20 or a 30 or a 40,000 rand expense that you didn't budget for and that you do not have reserve funds for. And the savings component can then in those cases be used for those expenses. So those are the principles. The vested component cannot receive any new monthly contributions. So that whatever you had on 31 August in your pension fund was locked down and transferred to the vested component. You cannot add to it. So all your new contributions from September will be added 2/3, 1/3 into the savings and the retirement components respectively. And so this is how these two components are going to grow. So on day one, if any of you who are aged late 30s or 40s or in your 50s, if you're going to be getting a pension fund statement from Alex Forbes or from 91 in the next couple of days, you will see that there's almost no money in your savings and retirement component, because they are going to be built up from future contributions. most of your retirement assets are going to sit in your vested component because of the fact that you've saved most of your assets before 1 September. So slowly but surely, the relative size of these two pots will change over the next decade or the next 20 years. So that's the principles of what you're trying to achieve with each of the pots. Some of the rules I can add in, we spoke about rule number 1 for the vested pot, which is that it's all the assets on 31 August. The second rule is really the one that is causing all of the chaos at the moment in the market. So you would see that pension fund administrators are overrun with client queries at the moment. If you try and phone into the call center at Sanlam or at Alan Gray, I think Alan Gray is a bit better, but Sanlam and Alexander Forbes particularly, and increasingly also some of the life companies like Old Mutual and Momentum, you often find that your waiting times are extensive, that people's calls are being lost. And the reason is that millions of people are phoning into these pension fund administrators to find out how much seed capital was deposited into their savings component during the initiation process of two-pot. And this is the seeding piece. Here's the formula. So everybody who has old vested assets, 10% of your old pension fund assets with a maximum of 30,000 Rand is being transferred across to your savings component. And that happened last week, Monday or Sunday, what was it, the 2nd or the 1st of September. So if you are able to get your statement from your pension fund administrator, you will most likely see that your retirement component is 0, that there's a big amount of money in your vested component, and that there's around 30,000 Rand in your savings component. And it's the access to that 30,000 Rand or 10% that is causing all of the traffic for many of the pension fund administrators, because these clients all want to withdraw that seed capital amount. If we look at the rules that govern the retirement component, we discussed that before. Your retirement component is inaccessible. You can only ever access what is in your retirement component the day that you actually retire at age 55 or 60 or 65. You cannot in future touch any of your retirement component until you reach retirement. And then at retirement, what is in your retirement component is used to buy you an income. You cannot also do a lump sum withdrawal at retirement from your retirement component. These are part of the important changes that the two-pot system institutes. And then really the pot that's getting all of the love and all of the attention and all of the media noise is the savings component. And the savings component generally has a small balance of something like 30,000 Rand or less in it at the moment. And you are able to withdraw that amount of 30,000 Rand or less. You will pay marginal income tax rate on that. So for those of you on the call who are higher income earners, where your top marginal tax rate is maybe 40% or 36% or even higher, 43 or 45, those people, that's the tax rate that you will pay if you make a withdrawal from your savings component. So the tax system for savings component withdrawals is very penal for high income earners. And that already starts giving you a hint that the savings component withdrawal is not a good idea for people who are on higher tax brackets. You are better off finding another source of the money by either borrowing some funds against your home loan, your access bond, or against your credit card than trying to get those assets out of your savings component. The tax penalty is severe and significant. So that's what happens in the savings component if you withdraw during your working lifetime. So this is a first. We were never able to withdraw at any point in our lives from our retirement funds before we retire. You will now be able to do that. Whatever is in your savings component, you can withdraw. The only limits that apply to those withdrawals is that you can only do one in every tax year. And tax years, as a reminder, runs from 1 March to 28 Feb. And you've got to draw a minimum amount of 2,000 Rand. So you cannot make multiple small withdrawals from your savings pot. But the key hit for people on this call to pay attention to is that you will pay an expensive marginal income tax rate on any withdrawals before retirement. When you withdraw from your savings component at retirement, the rules change completely. I'm not going to go into the detail, but there are much more beneficial tax tables that apply then. So there's actually a really big benefit for you from a tax perspective if you do not access your savings component during your working lifetime, because not only do you then retire with more money, but you're able to make use of a very beneficial tax dispensation for lump sums at retirement. If you reach retirement and you've regularly withdrawn your savings component, and your savings component has got a small or virtually zero balance at retirement, you will have no lump sum and you will not be able to participate in any of those tax benefits that you get at retirement. So it's actually a really good idea to restrain yourselves and to not dip into your savings component to make sure that you have enough money for a good lump sum at retirement and a very tax beneficial lump sum at retirement as well. So that, in short, are the rules of the two-pot system. And as I said, the focus at the moment is on the savings component with all the withdrawal stories. Over time, the focus is going to go more towards the bigger picture advice. And when we do the client case study examples, you'll understand a little bit more about how some of your big life events are now going to change because of two-pot. So this is the first important piece. The second important piece to understand is not everybody in South Africa are in fact included in the two-pot system. We have about 6.5 million pension fund contributing members in South Africa who are members of retirement funds. And of that 6.5 million, we estimate roughly 700,000 odd of them are not in two-pot. And they're not in two-pot for two different reasons. The first reason is they own a really old life insurance retirement annuity. So if some of you manage to get through to the Sanlam call center or the Old Mutual call center, and you get a statement of your old Mutual Life RA or your Sanlam life insurance retirement annuity, if you get the statements and you see that the statement says that your balance in your savings account is zero, it's probably because you're part of this group. These old life company RAs are so complicated that it's almost impossible to convert them into the two-pot system, and therefore people who are in these products are not moving into the two-pot world. They're not getting a seeding benefit in their savings account. They will not be able to make savings account withdrawals. Their life company RA product is basically stuck where they are. They can transfer to an approved new generation product with the same insurance company, but you won't be able to get your seeding and your withdrawal benefit like you would with other RAs. So this is probably the biggest group of people that are excluded. We estimate this group size to be in the region of about 500,000 people. So if you see your life policy statement and you see that your retirement annuity from your life company shows a zero savings account balance, this is why you've been excluded. And then the second group is a very technical group. This is people who are members of Provident Funds back in 2021, 1 March 2021 specifically, and who are older than 55. If any of you think you are in this group, speak to Jim and his team. He can confirm that for you. But those people are also not included in two-pot. They've got a 12-month period to opt into two-pot if they want to. So that's why I think if you're a Provident Fund member and you are older than 55 on 1 March 2021, I'd get in contact with Jim and his team to check for you whether you qualify as part of this exemption. Because if you then want to be included in two-pot, you're going to have to opt in, complete a form, and send it to your pension fund administrator. And you're going to have to do that before 1 September 2025, which is next year, September. So those are the key exclusions. So we've covered the rules. We've covered the people who are not included in two-pot. So let's now do like 2 life scenarios. So we're going to do 2 life scenarios for a pension fund member by the name of John. John is not yet reached retirement age. He's younger than 55. His current balance in his pension fund at the end of August was 5 million rand, and his company's Provident Fund, where he's contributing 4 million of that money relates to what we call pre-T-Day assets and post-T-Day. You guys can ask Jim if you want to understand what that difference is. It's important from a benefit perspective when you reach retirement, but the point is he's got assets in both of those two buckets. And John is contributing 10,000 rands a month to the company pension fund post the implementation of two-pot. So that is John in a nutshell. What we're going to do with John is we're only going to cover two life events and two very important life events at that are affected by the two-pot implementation. And so we're going to use John as an example to explain to everyone on the call how the rules are going to now change if you resign from your employer in future. So in future, when you resign, the rules are not the same. There's some important changes that you need to be aware of. And then the other one we're going to look at is how, when you retire, the two-pot world is different from how the old pension fund system worked. So we're going to look at those two life events only. There are also other life events that affect your pension fund that are affected by two-pot and the implementation thereof. Those include withdrawals later on in your life from your retirement fund for whatever reason. They include divorce proceedings. If anyone is going through a divorce, then you'll know that the split up of the pension fund as part of the divorce proceedings is a very important component, and the two-pot system affects what happens there. The two-pot system also affects what happens on immigration and how you can access your pension fund if you decide to leave the country. Death benefits are also somewhat affected, although in practice actually not really, but it's an important life event to understand how that's going to happen. And then obviously we've got retirement at the end. So let's get into the first one, which is resignation and transfer. But before we do the resignation and transfer, let's follow John through the course of the last 2 weeks when his pension fund administrator had to two-pot John's assets. So what happened to John's assets? You'll recall that John had 5 million rands in pension fund assets on 31 August. And so as John gets two-potted, a number of things happen to John's pension fund. The first thing is that the 5 million that John had in his pension fund moves to the so-called vested pots on the left, and he's got two vested pots because he's been a member of a provident fund before and after March 2021. So he's got two vested pot balances in his vested pot piece of his pension fund, and then he's got a savings component and a retirement component. The balance in the retirement component is 0 because there's been no new contributions after 1 September. The balance in his savings component is 30,000 because he was seeded with 30,000 or 10% of his fund balance in the vested pot on 1 September. And that 30,000 came from the two vested pots. Therefore, the two vested pots are not worth 5 million anymore. They are worth 5 million minus 30,000. And so that's how John's pension fund statement. So what was a simple pension fund statement on 31 August that just showed a fund balance of 5 million has now become a much more complicated pension fund statement that shows a fund balance in a number of pots, which if you add them together, still give you 5 million, but the 5 million is now distributed throughout the various pots. So this was John last week, Monday. Now we fast forward, John, to 1 September next year. So it's a full one year later, 12 months has expired. John's now made some contributions into his savings and retirement component because he's been contributing for a year. His vested components balance has remained unchanged. I've ignored market growth in this example to help you follow the numbers, but in real life, there will be market growth included in all of these balances. But I've ignored the market growth just so you can easier follow what happens to every pot. So the two vested pots stay the same because they're not allowed to get any new money. The savings pot has grown from 30,000 to 70,000 because there's been 40,000 of new contributions that's come in. And the retirement component's grown from 0 to 80,000 because of the new contributions that have gone in there. And so this is what John's statement looks like in September 2025 next year. When John decides to hand in his resignation, and he resigns from his employer and moves to another firm in a different position. So what are John's options now with his company pension fund? Well, it depends what John wants to do. So if John wants to maximize his cash withdrawal from his pension fund, let's say John wants to start his own new business. He wants to break away from the corporate, start his own consulting operation, and he needs capital to start the business. So what John is going to do is he's got the option of cashing in his entire vested component, because those are the rules that applied before 1 September this year. So in the pre-two-pot dispensation, John could cash in his entire pension fund. He can now still cash in his entire vested pot. The money is available for him for use, and he will pay the same tax that he used to pay in the old dispensation. If that's not enough, John can also now access his savings component, and he will now withdraw, or he can withdraw, the 70,000 Rand as well. He will pay income tax on it, so that's a higher tax rate over here than over here with the vested pots, but that's just the way the new system works. And John cannot access any money from his retirement component. So his 80,000 Rand has to be preserved in a preservation fund or a retirement annuity, or his new employer. And again, if you want to understand what those options are in future, speak to Jim and his team. They'll be able to explain those to you. So that is if John wants to make a cash withdrawal. These are his options. If John doesn't want to make a cash withdrawal, he can stay in the existing old employer fund, or what he can do is he can move the funds, so all of the pots, he can move it to a preservation fund with 91 or with Allan Gray or Momentum or Sanlam. And when he does that, his components will all convert and go to those new retirement funds where he's moving his money to. So that's the important change that now happens at retirement. Before two-pot came along, John would have been able to cash in his whole pension fund, pay withdrawals tax, and take the cash and go and invest it in his new business venture. Post two-pot, he cannot access his 80,000, and his 70,000 in the savings pot is now taxed at marginal income tax, which is much more significant than the tax rate he would have paid under the withdrawal tax dispensation. So that's the one important life event that will be changing. The second important life event is when John eventually retires. So we now follow John to the year 2055. It's a long time in the future. John approaches his advisor at Financial Fitness and asks them to retire him and give him advice on how to structure his retirement. Well, the best way to think about John's retirement then would be to look at his old vested assets separately from his new two-pot assets, although it's not really new two-pot assets because at this point he would have contributed for over 30 years. But in principle, what you do is the old vested assets, you retire from those assets using the rules that applied back in 2024. So the old rules of you can draw a third from this pot and the rest has got to be annuitized, and you can take all of this in cash. All of those old rules are still in place, even though it is 30 years after two-pot came into being. Your vested assets are still protected. There's still no reason to resign your employment to cash in your vested assets. They are well preserved, and your tax and liquidity and access rights are in place and remain in place even at retirement. Then after you've retired him from his vested pots and he's taken his lump sum that he wants, whatever's left in the vested pots that was not withdrawn as a lump sum is added to the retirement component on the right and used to buy an income. Then we can access the savings pot and also pay with retirement tables tax if he wants to, which is a very beneficial tax table. And he can take the full 2.5 million, or he can take less. What he doesn't take from the savings component as cash is transferred across to the retirement component, and that is then used to buy John an income for life. And so this is how the retirement process in future will change. You will now have these three different sets of pots that will all be treated differently at retirement. And I think it's probably fair to say that the two-pot system is significantly complicating the process of retirement planning. And probably even more than ever before, necessitating the need for people to have an appointment with an advisor if they in the two-pot system start approaching the last 10 years of their working careers. There's some other noteworthy points, some of which I think might be very technical. I think I want to focus on the last 2 points on the slide, which is that your vested pots will be doing a sterling job at protecting your old rights until you retire. So please don't rush and try and cash in your old pension fund assets because you're scared that two-pot will damage those assets in some way. It won't. Your assets are fully protected under the vested pot regime. And the other interesting side effect that I want to draw your attention to is that RAs are now much better positioned relative to other pension funds and provident funds. RAs in the two-pot world are essentially now identical. Same tax, same liquidity, same limits. Everything is now the same. So RAs have received a significant upgrade as a product and is no longer a need to set up an umbrella fund for a small to medium company just because you want the liquidity benefits that's on offer. You now have the same access and liquidity benefits in normal, straightforward retirement annuities. Just some operational aspects. I think you would have seen in the media that there have been some publications about the backlogs that are starting to develop at some of the pension fund administrators. There's also a big backlog that's going to start developing at SARS. So the key thing is that you cannot make a withdrawal from your savings component without SARS giving a tax directive to tell the pension fund administrator how much tax to deduct from the withdrawal. And that process potentially is going to get backlogged as we estimate about 4.5 million savings account withdrawals have to be processed by SARS in the next couple of months, 2 to 3 months. That is going to cause a significant logjam at SARS, and so that's going to cause a delay in the payment of withdrawals. Also, if you have got outstanding tax debts to SARS, let's say you're in a dispute of some kind, SARS has issued you penalties and interest and you're disputing these at the arbitration courts, then if you make a withdrawal, SARS reserves the right to confiscate your full savings pot withdrawal for the IT88 outstanding debt. So again, for people with complicated financial affairs, you're going to all of the risk of a potential delay for the tax directive or having your withdrawal confiscated by SARS under IT88. Those risks are not worth it to get your hands on 30,000 rands. There are much safer ways to get your hands on 30,000 rands as a higher tax paying and higher earning investor, and that would simply be to access money through your access bond, or really, if needs be, some overdraft facility or credit card facility. We don't think at this point in time it's worth the risk, and we would actively discourage people from accessing their savings pot in the next 3, 4, 5, even 6 months until this wave of withdrawals in the pension fund system has blown over. And then some practical tips. I think we've touched on some of these already. Actually, I think we've touched on all of them already. You can expect significant delays. The tax withdrawals are very penal. So the paying income tax on a savings pot withdrawal is incredibly expensive if you're paying 40% tax. And then we spoke about the IT88 and the conclusion being that it's probably better to get the money from your access bond rather. And that is I think a good rules of thumb for the next 3, 4, 5, even 6 months. I would say even until the end of the current tax year, rather avoid getting involved in the two-pot savings account withdrawals and leave that rather for people who desperately really need the money for survival purposes or to pay down expensive debt, etc. And to conclude, just kind of a couple of comments about the two-pot retirement system from a slightly higher perspective. The first one is that the system on balance is a good system. So I don't think we should badmouth the system or link it in any way to COVID and paint it as a bad development. The private sector was intimately involved in the design of the system. We are confident that the system in its current form will see a return to growth for the retirement funds system in South Africa. because of the 2/3 piece that's going to be preserved in future. Younger people are now going to be forced to preserve 2/3 of their pension fund assets every time they change their job. They're not going to be able to cash it in and upgrade their car to the latest, greatest new BMW model. They're going to be forced to preserve 2/3 of their pension fund, and that will serve the industry and the pension of the future very, very well. The second part, I think there was a mention in the previous speaker about the market impact and the economic impact that is going to come from seeding. We estimate somewhere between 40 and 100 billion rand will be withdrawn through the savings pot system in the next 3 to 6 months. That money will make its way back into the SA economy, not all of it, but a big part of it will make its way into the SA economy. It will result in consumer spending, which could see some of those SA Inc. shares that were spoken about earlier getting a nice earnings boost and a nice rally. So there are definitely some positive spin-offs, and of course, we might even see a movement on our GDP. As the previous speaker mentioned, some surprising things could happen if South Africa's GDP breaches the 2.5% level on the upside, and Two-Pot might just make a little contribution towards that potentially happening in the fourth quarter or the first quarter of next year. And then the last one, I guess to conclude, retirement fund policy is unfortunately mired in politics because the retirement funds deal with such a wide range of people from all walks of life and all industries and all levels of income and financial sophistication. There's always an enormous amount of politics in the system. So there is the risk that the system gets amended by some political meddling or intervention at some point in the future. And then we'll have to reevaluate what the impact of that is going to be. But for where we are today, as a private sector player, 91 is very comfortable with what's been happening with the Two-Pot system. And we are confident that it is, on balance, a good development if implemented responsibly for the SA retirement fund system. Jim, I think I'm going to call it a day there. That's the end of my talk. I'm going to hand over back to Jim. Thank you for listening. And I hope you enjoy the rest of the session. Thank you.
Thank you very much, Jaco. That's a very understandable presentation of a difficult topic. And I do believe that our clients will now be quite significantly more comfortable than they might have been earlier today. So, but there will be lots of questions, and I'm encouraging each of you watching this evening to write your question out to your wealth planner at Financial Fitness. Send that question in. We will have these slides and lots of additional information to provide for you. So don't worry that if you didn't catch all the detail or you weren't sure about this or that, those questions can be answered for you tomorrow. So please send those questions to your wealth planner. All right, Jaco, we will let you go now, and thank you very much. And we'd like to introduce Mr. Tony Bell. Tony's got the accolade of being a little bit longer in the industry than the first two speakers, at least over 36 years in the investment industry. And most of you will recognize Tony from a number of our presentations in the past at Greyston and other venues. Tony was with Vunani until 2019, even though he was running the Global Marathon Fund for us since 2015. He left Vunani to focus on his company, that his very unique investment approach company called ThinkCell, which is doing amazing things for us in our funds. Global Marathon being one, Global Macro being another in your offshore portfolios. And Tony, you know, very modestly tries not to tell anybody, but he has won over 10 or 11 Raging Bulls. Was it 10 or 11, Tony?
10, Jim.
And there you go. So number 11's coming up. So it's a great pleasure to introduce Mr. Tony Bell to tell you about what to expect, what we've seen this year in the global equity markets, and what you might just expect for the rest of the year. being that we have an election coming up in the USA in November. So thank you, Tony. Over to you.
Thank you, Jim. Thank you, everybody, for joining tonight. I'm just going to share up and then we can get going. Perfect. The agenda for tonight, and just a compliment to the previous two speakers, Jaco, I must confess I hadn't read a thing on two-pot, and it's really informative. So well done on handling a really big topic. Ladies and gents, tonight we're just going to do a very brief update on the Global Marathon Fund that I've had the pleasure of running for nearly 10 years now. And then I'm going to take you through and simplify what does appear to be a very complex global picture. We're really going to focus on 3 or 4 things, some of the events that happened earlier in the year. And then I'm going to share with you what our baseline view is for the US economy in particular, and share with you why we think the Fed is going to need to be a little bit more aggressive with their rate cuts, and then how that feeds into the positioning of the portfolio and where we see the risk at the moment. If we look at the performance of the fund, I'm very pleased to report it has done well since inception. So the red line at the bottom, line number B, is the sector average. That would be the average fund performance in the sector in which we are registered. And then pleasingly, line number A is the performance of your fund. The second chart is just the one relative to the other. And what I think is quite appealing about the history of the fund is that we've had a nice, long, consistent period of relative outperformance. We do have flat periods in between, but no major down periods, which is very comforting. Okay, let's try and look at the macro view. That was actually a picture I took in New York, handheld, quite pleased with it. But let's unravel the picture. When I look at financial markets, we really look at 3 things. What's happening with the liquidity environment, what's happening with the inflation environment, and what's happening with the interest rate environment. What equity markets like in general is lower inflation, lower interest rates, and no liquidity-driven events. What you see over here is you see a chart, which I'm just going to call up pointer, and I'll unpack it for you. It's the so-called yen carry trade that went a little bit wrong earlier this year. Very simple principle. The black line is the Japanese government bond. When the Bank of Japan introduced what was called yield curve control a number of years ago, they essentially promised to buy their own government bond if yields got to more than a certain percentage. And you can see in the chart, as the market broke the Bank of Japan in January of last year already, the yen started to depreciate, and a lot of yen being pumped into the market created a lot of liquidity. You may recall at the start of 2023 that the press was full of predictions about the Great Recession. That recession never happened, largely because central banks were very supportive of a liquidity environment that could have gone wrong. The Bank of Japan subsequently raised the limits of yield curve control, and as a consequence, started to buy Japanese government bonds at a higher yield. And the markets then took the Bank of Japan on again. And all of this played out earlier this year when we had quite a shock to the system, where the Bank of Japan decided to raise interest rates instead of continuing just to pump a lot of money in to buy their government bond. Why is this important? Well, it changes part of the liquidity equation. So previously, when the Bank of Japan was weakening the yen, using a lot of money to buy its government bond, that was feeding a stock of liquidity into the market, and that has turned around with the policy position change where the Bank of Japan has now raised interest rates. So that makes us a little bit more cautious on equities. The other thing that makes us a little cautious on equities is this thing called volatility. You will have heard of the VIX index. It's a daily published index. And the simple rule of thumb is if it gets above 30, one needs to be a little bit cautious that the market is becoming unsettled. One never knows what triggers a liquidity event. But as Jim says, I've been around since the 1986 crash, and whether it's 86, 92, 94, 98, 02, 08, 2020, there was always some event that caused the market to become unsettled. And you can see over here, the yen carry trade unsettled the market quite significantly. The intraday volatility actually went as high as 60. And that's problematic for markets because if markets don't have certainty about pricing and the volatility is too high, it can unsettle markets and cause imbalanced selling. So that would be risk number 2 we've seen for this year. Risk number 3 was inflation. And I think up until recently, there was a lot of concern that inflation in the US was too sticky. And the Fed, which has become so-called data dependent, remarkable how many PhDs they employ, but they only look at the data that's been published, is that the Fed has, in our view, become overly cautious, and we'll explain why. So what we've done is we've simply overlaid on various measures of inflation that are not important, the inflation surprise index from Citibank. And one can see that there may be a few surprises coming where inflation ticks up. But in aggregate, we think that inflation has now stabilized. The last print was quite low, 2.5%. And as a consequence, one then looks to the Fed policy to say whether to ask the question whether these 25 basis point cuts that the Fed is talking about are going to be enough. You may well have seen in many of the articles that the jobs market in the States is still quite strong. This is a chart of what they call job openings. These are jobs that are available to people should they seek to apply for those jobs. And at face value, 6 or 7 million job openings would suggest a fairly healthy and robust US economy. But there's a slight little twist to the story, because to the extent that these are job openings and not actual jobs, companies, if the economy starts to contract, will cut those jobs quite quickly, as we saw in previous cycles. So maybe that's not as comforting as the number would suggest. We do take some comfort from the fact that personal consumption expenditure, what we all spend in the US, is still quite robust. And I think we've been through a very healthy period. Whether one is pro-Biden or anti-Biden, he certainly has done a good job in lifting the US economic growth profile through the three major acts that he enacted while president. So it really comes down to a very simple, if I could use the sort of slightly tongue-in-cheek analogy, the sort of two-part process in the Fed's decision. The Fed has a dual mandate. It needs to keep employment as full as possible, and it needs to keep inflation as low as possible. So what you have on the chart is the unemployment rate on the horizontal axis and inflation on the vertical axis. And we have moved down to a position now where inflation is low enough and the unemployment level in the States is still strong enough for the Fed to be able to cut. And so Mr. Powell has been very cautious in broadcasting his intention about when he's going to cut. We know that he's now going to start cutting, but the question is how much. And often in the development of our investment thesis, we've looked to understand the picture of what the market is telling us as opposed to imposing our view on where the market should be. And the chart in front of you is very instructive because the black line is the US 2-year Treasury yield. In other words, that is the yield that US bonds are trading at on a 2-year term to maturity. And the gray colored line, which is the step ladder, is the Fed funds rate. That is the policy rate that the Fed sets in terms of their meetings. You can see back in 2021 when the bond market said, Mr. Fed, you are not tight enough. It took the Fed a while to catch up, and then it had to start speeding up the process. And sitting back looking at all the economic data over the last few months, I've just begun to wonder to myself, is the bond market not telegraphing that the Fed is too far behind the curve? That is a percent, add another quarter, add another quarter. That would suggest that the Fed is 1.5% behind where the bond market already is. And the Fed's only contemplating cuts of 25 basis points as it did over here. So we went and examined what the historic picture looks like. And it is a little bit sobering. If you take the difference between the Fed funds rate, the gray line, and the 2-year Treasury, the black line, you get the bottom chart. And based on our research, there have only been 3 periods in the entire history of the US economy where a rate differential this big has not resulted in a recession. So we're a little cautious in our approach on the equity stance because we think with the Fed being so cautious in cutting rates, it's just going to stay on the brake for too long, and other stuff starts to happen where the economy starts to contract, the job weakens a bit, market weakens a bit more than expected, consumers pull back a little bit more than expected. So we're cautious as we go into 2025. The very scrambled chart that you see in front of you is an attempt to try and look at the flags that we should be monitoring and see to what extent they weaken over the next few months in order to gain a level of confidence that's a bit higher as to whether a recession is probable. At the moment, the indicators are still relatively low, and that would suggest that a recession still has a low probability, but these are the factors that we're monitoring. So we look at industrial production, the manufacturing and retail trade, we look at personal income and the jobs market. The question then begs itself is, so if you take all of this stuff into account, where is the equity market? The chart in front of you has the same US 2-year Treasury yield, and on the horizontal axis, it's got the S&P 500 earnings yield, in other words, the inverse of the PE. An earnings yield of 5 equals a PE of 20. And so what we do is we say, well, what do we know? We know where the 2-year Treasury yield is, so we can actually just take a reading off the historic correlation and ask ourselves, where should the equity market be rated? At the moment, the market's on a P of about 26. If we take a bear case scenario, we get a value of about 12% lower. If we take a bull case scenario where growth continues and inflation just simply comes down, and the Fed is able to indeed engineer a soft landing, then there does appear to be good upside in the equity market, but we're tending in the structuring of the portfolio towards the more cautious side, given the leads and lags that a tight Fed policy induces in the equity market. We have within our team developed a long-term indicator that has been quite useful in looking at the sector positioning. And essentially what the indicator does is it looks to see which sectors offer the best earnings growth potential over the next 12 to 18 months. And those are the sectors that we typically choose to overweight. And we tend to try and avoid or reduce the weighting in those sectors where earnings growth is tapering off. You'll notice that information technology, which has been the darling up until recently, is not one of the best forecast sectors for growth. And as a consequence, you can see that we are significantly underweight the tech sector. Historically, this portfolio has been positioned exactly the opposite. We've been about 6% overweight tech. We pulled that back about 2 months ago when NVIDIA started to hit the highs, and we've taken significant profits. We're overweight consumer staples. We think that that sector has more robust earnings growth. We're overweight financials on the basis that we think their earnings are solid, and healthcare for defensive. So in the history of the Marathon Fund, this is an unusual positioning because normally we are overweight the higher beta, the higher risk growth stocks. If we look at the second last slide in terms of where we are positioned, what we've tried to reflect on this chart over here is on the vertical, some measure of value. Companies higher up are a bit more expensive. And then we've just looked at that earnings growth component on the horizontal. And whereas previously we would have had a lot of weighting in shares that are offered high growth, but were slightly more overvalued or more expensive, we've tended to focus now on where we think the growth can be more sustained, and there's more of a margin of safety in the rating. So if we put that all together and we just look at a color coding per sector, what you will always find in the Marathon Fund is a very conservative approach to the selection of quality equity. I know you hear that a lot, but it is something that we live by, because what we're looking for is we're looking for companies that have some ability to grow and sustain the growth of their earnings without undue competition. Maybe some interesting names in the portfolio just to conclude. We like some of the security providers. CrowdStrike had a bad patch recently. We've bought a little bit into CrowdStrike, but we like Palo Alto a lot. We've moved into some of the software design companies, Cadence Design. We've significantly reduced our weighting on NVIDIA. It is no longer the top stock in the portfolio. The top stock, in fact, is JP Morgan. And you can see a very nice spread of banking stocks in the portfolio. We pair trade, or we pair stocks up in the portfolio. So we have companion stocks. JP Morgan is a very good companion stock to Royal Bank of Canada, Bank of New York, and Barclays. So we've got a four-way diversification. We take MasterCard and Visa and combine them. And then in the healthcare space, we've recently started to look at Pfizer and add Pfizer in the portfolio at a much lower level. We've liked Intuitive Surgical for a long time, Eli Lilly and United Health, both solid earners. And so in conclusion, the real positioning of Marathon is one of relative conservatism. We're running at about 20% in cash, but in terms of the forecast, we're preparing ourselves to ensure that we have sufficient comfort with the earnings that are being generated by these companies. And we're watching those volatility and liquidity indicators very carefully. In the event that there's another macro event, we would further reduce risk in the portfolio. Jim, on that basis, I will thank everyone for their time and attendance, and hand back to you.
Wonderful, Tony. Thank you. Just one comment. I think you've mentioned to me that our position in Ferrari does not get us onto the invitation list for the limited edition models.
It's an interesting one to finish off with, Jim. we actually looked very carefully at the luxury goods model, and we thought that LVMH was unduly at risk in terms of their China exposure. So there may be a few smiles on the call with the ladies present, but we actually see Ferrari as a good companion stock to Hermes.
Indeed, indeed. It's one company that can sort of control its own order book and sell everything that it produces, basically.
I think it has a present order book, Jim, of about 2.5 years.
Yeah, enviable position. And Tony, just we can't let you go without giving us another few words of wisdom. You know, you've been involved with the stock market since the 80s, you know, sort of similar time to me, even though both of us don't look anything like that possible age. So it's amazing what a good, healthy lifestyle does for one. But Tony, tell us, you've watched many situation where, you know, people are predicting doom and gloom and it's all over. You're never going to make money again, and it always comes and then it goes, and then the market goes higher. So if you could reassure anyone out there who might be feeling nervous these days, just the resilience of the global equity market, Tony.
Sure, Jim. I think the first presenter hit the nail right on the head in terms of South Africa. The way we look at it, Jim, is very much the capital allocation cycle. So I've spoken about inflation, interest rates, and liquidity. That is the environment that the central banks and governments create for companies to do business in. And the key to linking them all together is where the capital, the risk-seeking capital flows. And the capital formation that has happened in the US in the last 3 to 5 years, you pretty much got to go back to the late 90s when we started to see the internet boom to find a comparable period. Productivity in the US is moving to new heights. The investment in the new round of AI is very comparable to the late 90s. And what this is doing is it's changing the way companies do business. You know, I marveled the other day when I was looking at something and I thought back to the days when many years ago we were hiking and we sort of spoke about the future and we thought, well, programmed TV is not going to happen anymore. It will be on demand. And maybe you don't sit and watch a TV program in your lounge anymore with a TV schedule, but you can see it on some sort of handheld portable device, and you can see what you want when you want, and that describes YouTube. So I think the one thing that people overlook is that the companies that we've presented tonight have an incredible level of innovation, and the capital formation is incredibly strong, and that's what creates these long-term compound effects. So when you look at stocks like NVIDIA, the compound effect of earnings over the last 10 years has been of the order of 2,600%. And it is incredibly difficult to ignore that level of compounding if you're constantly trying to time the market. The other thing that I could comment on is in being sort of in the investment game for 40 years now, I find that there is an old truism. I'm particularly hardwired to be conservative when everyone else is positive. And that was 2 months ago with NVIDIA. When we had the drop, some of these companies like CrowdStrike have dropped as much as 25% in 6 weeks. You've got to just stop and think about that for a moment. NVIDIA also had a fair whack to the price. And what I noticed was that clients were most anxious to know how many NVIDIAs we had in the portfolio when the price was cresting, and then how few NVIDIAs we had in the portfolio when the share was falling. And that's where your opportunity is the greatest. So the approach we use within Marathon is a very simple one. Over many, many years of research, my sense of the market is outside of dislocations where the market truly crashes. The share price that I see on my screen every day is a much better estimator of future earnings growth than the analyst or the valuation model. And so we use that as a powerful tool to try and figure out what the market sees in a particular company in terms of its prospects. And where you do have one of these liquidity dislocations, the opportunities are huge because value truly does dislocate from price. And it's at that moment that people are most anxious. And it's at that moment that the opportunity is the greatest. So as Yaku said, I think one of the roles that you fulfill in your guidance of clients and the custodianship that's placed in me and the company I represent is to exercise professional judgment at a time when it is very difficult for people to try and understand the call that they should be making on their investments. We essentially manage the risk on behalf of your clients. We have a lot of flexibility in Marathon, and it's something that we've shown that we can do repeatedly. And it's not a single variable that you look at. And for those of you on the call that know me well, you know that I don't have a TV set and I don't read newspapers. And I'd really encourage you not to pay too much attention to what you see on the TV and read in the newspapers, because the market itself paints a very different picture and tells a different story. So I hope that answers
Well, Tony,
the
yeah, that's a great note to end on. Thank you very much. Thank you for the results that you've given us with Global Marathon over the last nearly 10 years, and the results we're getting in the USD denominated global macro. So thank you very much, Tony. We will see you again soon. Good night. Good night,
Thank
Tony.
you, everyone.
And to everyone who has tuned in, thank you for being here. As always, you know, you're our clients, you're our valued clients. We want to hear from you. We especially want to hear your questions tomorrow in the emails to your wealth planner. And if you have any suggestions for us as to what topics you'd like to hear about in the future webinars, what times of the day that might suit you, and how long these webinars might be, those are kinds of feedback that we really would appreciate. We want to keep making these better for you. We want to make them more relevant for you. So with that, I would like to say thank you to Vicky de Jong for putting this all together. You've been hearing from her for the last 2 months regarding the webinar and reminders, and that's why you're here this evening. And to all of our staff at Financial Fitness for the work that they've done to assist in getting this to become an actual event this evening. So thank you for making it possible for us to offer these services, and we will look forward to hearing from you and seeing you next time, or if not, long before. Thank you very much. All the best. Ciao. Good night.